Hey guys, how's it going? It's Charlie Marr, and today I want to give a response to Everything Money's reaction over Oswath. And goes ahead and talks about value investing. There's no hate towards Everything Money. I actually watch a lot of their videos. I'm a great fan. It would be awesome to actually speak to them. But when I watched this YouTube video, I just didn't agree with a lot of what they were talking about. There were so many differences, and I just felt like I really needed to share my point of view, my perspective, and what I recommend you guys to do and follow. There's a lot of things that were just missed, and I just feel like they're so close yet so far. But before we get into it, I do want to say I'm completely winging it, so I'm not 100% prepared or don't have anything in front of me. I wrote up some notes in my phone, so I might look at my phone to kind of, when I watched the video, some thoughts that came up that I wanted to cover. And yeah, but let's just go ahead and get right into it. So let's go ahead and start this video. Let me put this in big screen here.
Hey, welcome back to Everything Money. We're glad you joined us. It's just Paul and I today. We are talking about a reaction video. Paul has reacted to YouTubers in the past, both positively and negatively. We've actually got Jimmy's friendship now because of a reaction video, Paul. But today, we had so many requests in our Discord community for you to take a look at this video. I've watched it a couple times. Some of these reaction videos, folks, can get quite fiery, where Paul starts bringing in people's mothers and it gets very volatile. But this one, I would not expect that's the case. Okay, this is Oswath, Damodaran. I'm saying it wrong. I apologize. But very, very famous value investor, Paul. And
I know who he is. He's an NYU prof.
People wanted to hear your thoughts on this. We probably won't go the whole time, but this is just quite interesting, Paul. So let's get after it. Value investing.
Hi, welcome back. In this, the third and final session on value investing, I'd like to take a look at where we've gone in the first two sessions. In the first session, I talked about what I call the glory days of value investing. Much of the 20th century, low PE and low price to book stocks outperformed high PE and high price to book stocks, and most of the legendary investors seemed to come to the value investing crowd. Then in the second session, I talked about the dark side of value investing, which is even in the glory days, there were some days that were not that glorious. In particular, there were periods of time where growth investing beat value investing.
Of course.
And on top of that, active value investing didn't seem to add much value, just picking low PE or low price to book stocks. I ended that session by looking at why value investing has failed, especially in the last decade. Now, leading it from 2010 through the COVID days, it's quite clear that the punch that value investing once delivered is no longer there. Low PE stocks are underperforming high PE stocks.
I love that.
Say that again.
I love that happens. I mean, listen, cycles have to happen, and people have to get to where they are now, where they say value investing is dead, right? We hear that all the time now, and it's like, okay, that's good. When we hear that, it means that we're probably very close to some sort of turnaround in that.
Okay, so here is the very first thing I felt like I needed to share. Value investing is not dead, and value investing has not been underperforming. It's all about a perspective. And when you see these articles and when you're seeing people talking about value investing is dead and it's underperforming and growth stocks and all these other methods are beating the market or outperforming value stocks, it's because it's being seen in a perspective that they want. It kind of reminds me of technical analysis. When you're looking at all the little charts and like everyone sees a bullish pattern and a bearish pattern, the eye sees what the eye wants to see. You see what you want to see. You create the truth, in other words. And the thing that I think is a big misconception, or that's completely not understood correctly, is that as value investing, well, first of all, I kind of need to talk about how there is like 4 stages in the market, but that's a whole different story. But what I want to get to is I think they're forgetting that when you're value investing, especially the way Warren Buffett first started and these old methods, it's a cigar butt method. So the whole point of these is to get a quick puff out of it, just to get that free puff and to move on. And they're missing the idea of rinse and repeating this method and the beauty of the 8th wonder of the world, compound. And it's compounding your returns. So if you see all the growth stocks, let's just say they all ended the year up 200%, and maybe value investments or these low PE stocks all ended up under or at 100%. So obviously, when you look at it that way individually, on average, yeah, the growth stocks performed better. But what they're missing is the rinse and repeat method with the value investments. It's being able to do two or three of these, compounding your money and ending up with even higher returns than what the growth stocks bring you. And that's what people aren't seeing. And the whole point of this is to kind of get that quick puff. You're supposed to get in and get out. And there's more about this later. But anyway, I just wanted to get that out there. And that's just what they're not seeing. And if you have a small amount of money, that's what you need to be doing. Warren Buffett made his first millions, many millions, going in and out of the market. In fact, I'm going to make a part 2 where I combine all the videos of Warren Buffett talking about this. And he doesn't even know the names of these stocks sometimes. He was like, I didn't even know how to pronounce some of these companies' names because he was just focused on that cigar butt method, on buying below liquidation value, which is, there are things out there like that. Anyways, I don't want to get too much into it now. I just wanted to put that out there.
Because it's a bunch of young kids and younger adults who've never experienced a bad market will go and say, oh, wait, like, why should I invest in a 12 PE when I can have this company that's growing 30% a year and the stock is doubling every year?
Sure.
All right, go ahead.
Dividend paying and low dividend paying companies are doing better than high dividend paying companies. And I suggested that the reason you give for that phenomenon will lead to what kind of action you will take. For those who believe that this is a passing phase, all you have to do is wait. For those who think that this is all the work of the Fed, even central banks will lose power and you just have to wait again.
That's a very common thing I hear. Don't fight the Fed. I'm like, listen, at some point, the Fed will not be able to put enough bullets in the gun. It's just, things can't last forever. If the Fed could keep the stock market up forever, why wouldn't they? But they haven't done it. Like, COVID hit. And yeah, COVID rebounded, but it fell 40% in a matter of 1 month. I mean, if the Fed just had to print money immediately and do it, why didn't they? I mean, it doesn't add up.
Mm-hmm.
So be that the world has become a flatter place. Things that were exclusive, being able to find the data and work with it, are no longer exclusive. And on top of that, in a changing economy, it might be time for value investing to re-examine how it approaches investing.
I would say, Paul, that really spoke to me, the idea of these numbers are now out there. I mean, when you started investing in high school, you told us stories that you would call the Akron Beacon Journal
from the payphone in the Commons, remember? From
the cafeteria while I was grabbing ass, and and it's like, it's all out there now. I mean, you fire up TikTok and people just like, it's like a daily thing, especially for young people. So we talk about how the idea of like, it's positive that young people are starting to think about saving, but when they start maybe gambling on margin and options.
Well, the one criticism of Robinhood and many other of these apps is that it gamified investing. It didn't make it about investing. It made it about, picking this, that.
This whole part, I agree with them. Like, I'm not for those methods. Actually, I didn't even touch options until after I had made over $1 million in profits in the market. I don't recommend margin. I don't recommend options. I don't recommend, obviously, leverage margin, same thing. I don't recommend even IPOs, all the SPAC plays, or just all those hype stocks. I'm a contrarian value investor, so I like to focus in the market where nobody's focused on. I like to buy things where people are hating, when companies are distressed. So I agree with all this so far.
That and the other that's going to go up and down every single day. You know what I mean? So, the example I always give is when the caddy at the country club I played golf at tells me I'm wrong about Tesla, Palantir, and Bitcoin. The 17-year-old kid, I'm like, okay, that to me is an indicator. It's like Peter Lynch always said, the cocktail party. If I go to a cocktail party and everybody's telling me what to buy, stocks are too overpriced. If they feel bad for me for what I do for a living, probably the right time to buy stocks.
Yeah, he keeps going, Paul. There's a lot.
So funny enough, that's actually how I knew Bitcoin was at the top, because I got to the point where like my friends' parents or my friends' brothers were trying to pitch to me what coins to buy, and I started seeing memes, and that's usually the indication that we're at the top, like at the end of a bubble, or like it's about to pop. And in December of 2017, because I did go for a ride on crypto. I mean, I saw that coming. I saw all this money rushing in, and I was going to take advantage advantage of that. I really was. So I did profit off of that. And I got out because I noticed all that. There was the gardener. I was building a house and they started talking to me about crypto. So I do like that whole thing. That part is
Bought in here.
In this session, I'd like to build on that concept. I'm going to argue, and this is just my point of view, and of course you can disagree with me. I think value investing has lost its way. There was a time when value investing brought something to the table. Maybe when Ben Graham published security analysis, it clearly made a difference. But since those days, value investing has lost its way. And in fact, there are 3 R words that I use to describe value investing, and none of them are complementary.
Okay, so yeah, this is where I just don't agree. Value investing has not lost its way. I actually think in this scenario, Oswath, in this case, simply has a lot of money, which is what 90% of you are watching. 99% of you don't have millions and millions of dollars, or sometimes not even hundreds of thousands of dollars. So his doors and the opportunities for him to make high returns in the market, investing with smaller stocks, which is stage 1. You want to buy kind of crappy companies or unheard of companies or companies that are not that popular for amazing value. You want to buy a dollar for 50 cents in this case. And in his type of in his world, that doesn't do anything. So for him to be telling people that value investing is dead is just, it's very bad in my opinion. I don't agree. And all these listeners, I mean, there's people here investing with 10,000, 5,000, 200, even 100,000, heck, even $1 million. You can still invest in stage 1 and buy all these small stocks that nobody's talking about, and they bring high returns. It goes back to what I was saying. It's the compound. There's so many stocks out there, and I can go through so many, like since 2015, and I find some every single year that are kind of like nets or trading below liquidation value or even below intrinsic value, but by a big margin of safety, which qualifies as value investing. And you can make so much money. And obviously the whole goal of this is not over diversifying. You don't want to over diversify. I mean, diversification is protection against ignorance, or how Mark Cuban says it, it's for idiots. It's for people who want protection. It's for people who don't know what they hold. And when you don't know what you hold, you want to have a lot of things because you're like, okay, if I'm wrong here, I will be okay here. But when you really know the value, not the price or not targets, the value of what you hold, you want to put your money and focus on your top ideas. It doesn't make sense to have a list of your top 20 stocks and you put money on the 10th, 7th, or the 20th one. Put your money in your best top ideas. And you do that because you know the value of these. And there's so many investments out there that qualify for this, that run up 100%, and it's a lot of them. A lot of these stocks have huge runs, and I'm living proof of this. I could find 3 or 4 a year that run 100 to 200% returns. So if I have $10,000 and I put those $10,000 in one of these small caps, and it goes to 20,000, I buy when the value is there. So I buy $1 for 50 cents. The moment it's $1 for $1 or $1 for $10 for $1 for $1.10, it becomes overvalued. It no longer makes sense to hold. You sell, and this could happen sometimes in 2 months, sometimes 2 weeks, sometimes it takes a year. But on average, I just noticed it happens in 4 to 6 months, and you're able to repeat that. So you turn your 10,000 into 20,000, and now you put that money on the second one. So you do it again and you put 20,000, you buy $1 for 50 cents, and you go from 20,000 to 40,000. Let's just stop right there. Let's just say you only did 2 of them, or you did 4, but it was at the same time, like 2 pair and 2 pair. Okay. You just went from $10,000 to $40,000. That is 4 times your money. That's how you beat these growth stocks. That's where value investing is not dead. And that's how you make really high returns in the market. Don't get me wrong, it will be volatile. The market, when you're doing these kind of stocks, when you're aiming for high returns, your portfolio will be volatile. So it's not for like people with weak stomachs. I mean, you will see your net worth or your portfolio drop 20%, 30%, sometimes even more. I have had stocks like Tuesday Morning that went from 22 cents to 11 cents, down 50%. But then they exploded like 5,000%. I wasn't fortunate enough to ride that whole way because I don't play games with my money. I bought when the value was there and sold when it wasn't, and it just so happened to go even higher. But again, that 100%, 200% profit was there. And anyways, let's just go on because I can go on. There's so much more. There's so much more that they're missing, and it's just I don't like how a lot of you are coming to YouTube or to people and to services and all these stuff because you want to make money. but they're showing you how to make money when you already have a lot of money, which is what we'll talk about later.
This is where it gets into
The
it.
first is value investing has become incredibly rigid. It is full of things you're not supposed to do. You can't invest in stocks that don't make earnings. You can't invest in tech companies. By carving these rules, value investing has removed larger and larger segments of the market from your universe. It's also very ritualistic. There are things you're supposed to do as a value investor, and God help you if you deviate from the script. What are these things? You're
I don't agree
supposed
with
to go
that.
to.
Go ahead, Paul.
I don't know. I don't know if I agree with that. I look at security analysis was a very rigid way, but then
This part I agree with Paul. Like we both don't agree with Oswath in this part.
Philip Fisher wrote his book, Common Stocks and Uncommon Profits, where he brought about the whole idea of, listen, growth is an important part of value. And maybe if he's just comparing security analysis, that might make sense. I mean, security analysis is all about buy, less than net working capital, buy less than assets, buy less than, book value. And I get that. And even that investing, I don't like doing. I don't like doing the investing. If you guys have seen my videos, these videos, I want to find companies that are stable, that are growing at reasonable rates, but that people have dismissed. I'm okay with Palantir. The problem with Palantir is I don't know what the future is, and I can't determine the future very easily, especially the number of shares there. If I had a better understanding of how they're going to make money and their share selling amount, I could value Palantir. But if I can't value it, I move on. It's easier for me to value a Google or a Microsoft or Apple because there's a more established history that I can then determine, hey, will these companies be around for a while? Yes. And if so, can I reasonably determine a range of where I think they're going to end up making money? But I do.
Okay, so this is kind of where it starts to divide big money versus small money. What I believe you shouldn't be following if you're trying to make high returns in the stock market and have a lot of money. And I can give so many examples. What is his name? Paul. I think his name is Paul. What Paul is doing is he's value investing in a way. I don't necessarily call it value investing. To me, it's more speculative. And the reason I call it more speculative is because the kind of stocks he's holding, they're not based off net value or liquidation value. They're not based on that. They're more based on, like, if the company continues to perform the way it's been performing, then in 5 years, it'll be worth X amount. Therefore, the way it's trading at right now, it's undervalued. I'm value investing. That's value. To me, that's not value investing. In a sense, yes, you can put it under the value investing category. But to me, value investing quite literally is buying $1 for 50 cents. And the way the kind of stocks that he buys and that he suggests, it's like buying $1 for $1.50 because you believe it'll be worth $3. And you have evidence, you have proof, you sync the numbers, and it's showing it's heading to $3. What I'm telling you is wait, don't do that until you have a lot of money, because your returns aren't going to be as big following this stage 2, as I like to call it, than in stage 1, which is putting that money in less stock, in stocks that are shitty or smaller. Now, remember, we're talking about cigar butts here. We're talking about getting a quick puff. You're not here finding a full cigar that you're going to smoke and I don't know, however long you smoke a cigarette and enjoy a vacation and like you're kind of relaxed. No, you're like a crackhead. You just want a quick smoke. You want to get a quick high just for free, get your money and leave and go to the next one. And you compound it. And when I kind of lost my train of thought here. When you're, how do I say this? So again, in his stage, he's investing in stocks that, let me give you an example. If you were to have invested in Apple, which is the kind of stocks that he looks for, he kind of looks at for stocks that have growth and EPS and that money's going to come in the future and stuff like that. Again, buying $1 for $1.50 because you believe it's going to be worth $3 versus buying $1 for 50 cents. Buying $1 for 50 cents is, I think he kind of brings it up afterwards, but it's like they have $200 million in cash. After they pay all their liabilities and everything, maybe they have $150 million left. And then you can discount it, and maybe they have $80 million left. And the stock is trading for $40 million, or the market cap is $40 million. That is buying $1 for 50 cents. That is stage 1. And there's a lot of opportunities like that, but they just happen to be smaller market cap stocks. When you invest money in stocks that small and you have $10,000, because they're such small market cap stocks, you can move in and out of them pretty quickly. You can put $10,000, and if it goes from 40 million to 80 million from 50 cents to $1, and that's your value investment, you make 100% profits on your portfolio. Or maybe you had 3 of those. I don't diversify. So that is value investing and buying $1.50 in my thing. Now, what was I going to say? I'm kind of losing my train of thought here because there's so much that's just being missed. So again, now if you do this method with them, and when he has a lot of money, it's, again, let's just say you bought Apple 10 years ago. You were fortunate enough to catch Apple, or you know what? Let's just use Amazon, because I think Amazon has a higher return. Let me look at my notes here because I'm going to talk about both of them, but I think Amazon's the one I want to focus on. Okay, yeah. So if you were to have bought, let's just say you're 20 years old right now, you're 22, and you found Amazon at $150. This was 10 years ago. And you foresaw everything and the growth and this is where it's headed. And it's a growth stock and that. Awesome. But if you invested $10,000 into Amazon when you were 22, 10 years ago at 150, and now it's at $3,200, that's about a 2,000% return on your investment. I think I wrote it down here. Let me see. I didn't write it down, but I think it's a 2,000% return on your investment. That means that you turned your $10,000 into $200,000. But you know what? That took 10 years. You're 32 by that age. You turned 10. I don't know if these guys know this, but a lot of you guys watching this aren't investing $1 million, $2 million, where you turn $1 million into $20 million. That's not happening. You're investing 10,000, you're investing 100,000, you're investing 5,000. Some of you are investing $3,000, but you're following what big money's doing. So you're turning your $10,000 in this example into $200,000, which, don't get me wrong, that's awesome. That's a good amount of money. You're still profiting, you're still growing, but after a decade, you only made $200,000. And technically you made $190,000. And technically you have inflation. So you made a little bit less. And then you have to pay taxes on top of that. And so do you see where I'm coming? And in my opinion, $200,000 is not that much money. I'm sorry, but that is not a lot of money. You will make more money just cutting grass. If this is about money, then you would make more money just cutting grass, having in the 10 years, than you would investing $10,000 into the Amazon or to the next Amazon. And it's the same thing with Apple. If you invested in Apple 10 years ago, I don't remember what it was trading at. Actually, I have it right here. We can look at that again. It was trading at, so Apple was trading at $10 and now it's at 140. That's a 1,300% on your investment. That means that you turned $10,000 into $130,000. That's even less than Amazon. Now, let's not forget, we're not talking about just putting all your money into it. Chances are, all of you watching, you have your $10,000, but you're not putting it onto Apple. You're putting it into like 5 or 10 stocks, which cuts down your return on your investment because you're over diversified. So maybe you had Apple, Amazon, and I don't know, maybe 4 other stocks. You no longer turned $10,000 into $200,000. Maybe you turned them into $100,000 because now you're over diversified. So now you're averaging all of their gains. So you still made a lot. That's where I'm getting at. I'm sorry, but that's not good. I saw these guys make a video about a young kid who was like 11, and they were projecting his profits and like how much money by like he's 11 and he was investing like $5,000, and by the age of 60, he barely got out like to like $2 million or $3 million, or not even. I think it was like 2 million. Like, that's really, is that why you're investing in the stock market, to make $2 million at the age of 60? No, you want to invest in the stock market now because you want to make a lot of money. You want to buy a nice house. You want to buy a nice car. Why the hell do you want to make $2 million by the age of 60? And that'll be worth even less. That'll be worth like $1 million with inflation, which they talk about. That's not how you make big money. That's not how Warren Buffett made his millions of dollars. He made his millions, hundreds of millions of dollars, buying $1 for 50 cents, liquidating companies, and doing things. Now, if you have $10 million, $5 million, and you bought Apple at $10 or Amazon at $150,000, that's a whole different ballgame. You turn $10 million into $200 million. That is stage 2. That is big money, and that's fine. Now, if you were to repeat the whole process again and you did another decade, your 200,000 are going to be like $3 million. That doesn't make sense to me, and I'm living proof of that. Okay, anyways, we have a lot more to cover, but I just wanted to throw all that out there. Like, there's nothing wrong with buying big companies, big stocks, and buying $1 for $1.50 because you believe it'll be worth $3, and holding and looking at growth and all that stuff. There's nothing wrong with it. You will make money. But there's a difference between settling and turning your 10,000 into 200,000 and turning your $10,000 into many millions, which is what I've done. I've turned like $3,000 into over $11 million, and it's happened in 5 years. Why? Because I turned 10,000 into 20, 20 into 40, 40 into 80, 80 to 160, 160 into 320, into 640, into over a million, 3 million. Just this year, I've made over $8 million, and it's just compounding like crazy. Now, so anyways, let's just keep going.
I think maybe he's right on this one, actually. Now that I talk about it, like if he's just talking about security analysis, then I agree with that. Like even security analysis with me, I tell people don't read it. We're not looking at just price.
Sorry to interrupt again. Yeah, don't read those books. I don't recommend you read Security Analysis or The Intelligent Investor. You should start with a book like How Buffett Does It. So those books are just so advanced. You can read the whole book and you'll still be lost. Like when I first read those books, I read through them and I got through so many chapters and I was still confused. So I don't really recommend them. I recommend them down the line. They're just too advanced and for other reasons.
The book, we're looking at earnings growth and all that stuff. Go ahead.
Every year, you're supposed to pay homage to Warren Buffett. You're supposed to claim you read Ben Graham's security analysis. And finally, value investing has become very righteous. Rather finger wagging in value investing.
That's
where
true.
They tell the rest of the world how shallow they are, how speculative they become.
I've done that. I do that all the time. But the reason being is I sit there and say, you're overpaying for growth. You're not doing the numbers. Every investment is the present value of all future cash flows. And I am righteous when I say, if you don't look at that, then you're missing something.
Mm-hmm. Or stupid.
And I'm going to bang your mom.
Punishment that is coming down the pipe. It's rigid, it's ritualistic, and it's righteous.
By the way, pause.
So
I have emailed him before, and he never responded. It was like 3 or 4 years ago. So Aswath, if you could please just respond to my email, I'd appreciate it. I'm a YouTube celeb now.
We'll have you on the show.
With 84,000 subscribers.
We're flossing. We can have you on the show and we can debate this in live, Paul. That'd be
There's
wonderful.
no debate. Like I agree with him. I mean, now that I think about it, he's right about the security analysis. It has become way too rigid.
Mm-hmm. Oh, wow. Okay. This is not where I was expecting you were going to go, but okay, here we go.
Investing to rediscover itself. It's got to go back to basics. And I'm going to make 6 suggestions. And again, you can add to these suggestions and remove those you don't agree with. But here are my first suggestions. If you're a value investor, I would expect you to even understand what value is. I am amazed at how many value investors I run into who have no idea what the difference is between value and price. You've seen me use this distinction before, but value is driven by cash flows, growth, and risk fundamentals, and price is driven by demand and supply.
I don't like the term risk, but I got you. I understand. I don't like the term risk. To me, risk is merely a price you pay for something, and I know it's simplistic, but maybe it's but for sure, cash flows and growth. What I always talk about. What's the cash flow? What's the possible growth from it? I always say that.
Yeah.
Okay, so here's another thing. Again, we're talking about investing small amounts of money to make more money. Like we're talking about cigar butts here. We're talking about these smaller, quicker. And I'm not saying get rich quick, by the way. Don't get me wrong. Again, this is not a whole get rich quick scam type of scheme. No. It can take sometimes a year, sometimes 2 for your stocks to play out, but you can have really good returns. Anyways, so yes, I do agree with them here that like there's so many people out there on YouTube who call themselves value investors or who think they know so much and they don't even know the simple difference between, or technically I guess it's complex, difference between value and price. Value is what you pay, price is what you get. Now, there's I think it was Benjamin Graham who said, everybody knows the price of everything, but nobody knows the value of anything. Like nobody knows the value of things. Everyone has all these targets and numbers and Tesla's at 2,000 and Apple's worth this much and this is worth this much and NIO is going to go here and Palantir is going to do that and everyone is just throwing prices and you tell someone, hey, what's this stock worth? And like they're just telling you prices and the stock, the price of the stock is not the company and the company is not the stock. Okay, so that is something that I do agree on. But I don't agree with the whole growth and all that stuff, because sometimes that doesn't even matter. Again, when you're buying these like liquidation type stocks or net nets, or trying to buy these, which net nets are a lot harder, but you're trying to buy, you're still trying to buy $1 for 50 cents. The past and the future don't really matter. Again, you're not going to hold these stocks for 5 years. So who cares how much they grow 3 years from now, 5 years from now? It's worth $1 right now. I can buy it for 50 cents. The moment it hits $1, I'm out. I don't care where it's at 3 years from now, 5 years from now, 10 years from now. And you know what? The moment I sell, I'm going to go put my money that I just turned those 10,000 into 20,000 into the next one. And I'm going to rinse and repeat that. And I'm going to compound. And that's how you turn a small amount of money into a lot faster. It's how Warren Buffett made millions of dollars and many others. And it's like a small world. Seth Klarman talks about this. Anyways, let's keep going.
Factors. And the reason I emphasize this is if you're a value investor, you should be focused on value, not on pricing. That said, if you look at how value investing approaches the world, almost every tool that value investing uses is a pricing tool. You pick low PE ratios, that's not valuation, that's pricing. So while value investing talks about value, much of what you see done in practice is pricing. And if you truly accept the fact that value is what you're searching for, we know what drives value. Value is driven by cash flows and discount rates. Cash flows are driven, if you want to break them down, into how fast revenues will grow, what your margins will be over time, and how efficiently you can deliver growth. And
Pause.
discount rate.
And look at our, what is our stock analyzer tool? It talks about what's your revenue growth, what are your margins going to be, and do some sort of valuation discount based on that. That's it. That's exactly what our software does for you. The stock analyzer tool does exactly what he just said.
So again, there's nothing wrong with this method. You will make money. You can outperform the market, but we're talking about really high returns on your investment, or we're talking about people who don't like to settle. And there's many different things, or you can always get an ETF, which does fine. If you don't have time, if you're super busy, that's a whole different story. So yeah, you can make money. I've made money with stocks like that. I've made money but that's more based on speculation, in my opinion, because you're saying based on what they've done, based on the money that has came, or is what's going to come. And maybe you see that with contracts. Maybe you see that money ahead of time coming in, but anything could happen. So again, to me, that still falls a little more into the speculation, but you can make money. There's nothing wrong with buying $1 for $1.50 because it's going to go to $3. But don't tell me you're buying $1 for 50 cents, because that's not exactly what's going on here. Anyways, let's keep going.
It says, what's your revenue growth going to be? What are your margins, and what multiple are you assigning to it? Great. This is your value in whatever number of years you want.
Yeah, I find all too often when watching some other YouTube channels where they're sort of talking about the grand futures of some of these companies, the idea of price and value is they just bring up a price, and then you see in the comments, boy, I'm buying it. Anything under blah, blah, blah amount, I'm buying. And I always think, why? How have you gotten to this amount? And then when it has a rise, Paul, or maybe a dip, they start resetting their values based on, I don't know what.
And somebody once accused me of that. They said, what do you think the S&P is worth? And my number was going up. They're like, so your S&P value is just going up because the S&P is going up? I go, no. It's going up. As you see, my S&P value isn't going up with the market. It's going up with GDP and income growth. That's what I care about, because as he said, what matters? The cash flow. I look at the cash flow of the market and say, okay, what are they going to earn over long periods of time? And there's a multiple to be paid for that. That's it.
That to me is speculative. Again, you're not buying $1 for 50 cents. You're buying $1 for $1.50, because they're not trading under the true company's value or book value, if you want to see it, even though that to me, that doesn't really matter. You're buying $1 for $1.50, hoping it turns into $3. He just said it himself, money that's coming. So this dollar will be worth $3. I'm willing to pay a little bit more for it. And I know everyone has numbers, so to them, it can be like buying $1 for 50 cents, and they can be like, well, it's worth $3. I get to buy it for $1.50 right now. That's $1 for 50 cents. But again, you're kind of going to the future, and now you're looking at like holding it for a long time. And it goes back to the first thing. Holding stocks for a really long time with a small amount of money doesn't really get you anywhere. At least not where I'm trying to go. I'm trying to make a lot of money. I'm not like, if you're just trying to retire, maybe just make $1 million by the time you're 60, then I get it. But if you're trying to make hundreds of millions of dollars dozens of millions or get to $1 billion, you need to change your ways. You need to zigzag through the way, kind of like Joel Greenblatt talks about. Anyways, let's keep going because there's still another half. But
I don't care if the S&P is 5,000 today, 50,000, or 500. My value is still the same. Right? So that's the exact thing about, and that's what he's talking about here, is what drives the value of a business. Well, what drives the value of the stock market? It's going to be the total cash flows of the business, of all the businesses combined. And that's largely driven by the economies they're in. All right, let's go.
What you demand as a rate of return will be driven by a risk-free rate and a risk premium. This is true for all companies. And to the extent that there's a risk of failure, you have to bring that into value. Now, if you're a value investor and you believe these are the drivers of value, we're ready to take the next step. And the second step is you cannot make avoiding uncertainty the center of your investing game.
Is that the center of ours? Yours?
No. Every single time we do a stock valuation on Stock Analyzer tool, there's uncertainty. I don't know what's going to happen in the future.
Yeah, okay.
But what I'm doing is saying, okay, do I think this $500 billion company is going to grow at the same rate it's done for the last 10 years?
That's what I've been telling you guys. Like, and it's based on speculation. Okay, there's a difference between a target and what you're aiming for versus in my world, I think I take it very literal. So in my world is, what is it worth as it stands right now? If you close down the business, got rid of everything, like that's it. You invested right now, tomorrow everything shuts down. What do you get out of it? That's what I see. I've seen so many companies like Cheetah Mobile, which a lot of people were investing in, and it was a value investment, and they were doing great. Guess what ended up happening? And I guess this goes into the uncertainty. There's always risk that they're like they do apps for phones and stuff, and they got banned from Google Play. There goes 80% of that future cash flow that they were speculating. Now, you can't see stuff like that. I guess that's kind of where looking into the management and doing more DD to kind of see what you're getting into, but sometimes you just don't see it. It's not there. You can't see some stuff like that in the numbers. But yeah.
Maybe not. I was wrong on Microsoft and Apple. I was like, okay, I remember 5-6 years ago, somebody saying, Paul, what do you think from a value perspective on Apple? And I said, it is a phenomenal value play if you believe their growth rate will be sustainable. It got better. That's why I was wrong on Apple.
Yeah.
I just didn't think a company that had $70 billion in revenue, whatever the number was at the time, was going to be able to grow that much revenue that fast in the future. I just didn't think so. Is that reasonable? I don't think it's an unreasonable assumption, but you can't avoid uncertainty. If you want to avoid uncertainty, buy treasury bills that are now paying 2%. That's what you should do. Because that's what he's talking about, the risk-free rate. The risk-free rate is essentially, what's the U.S. government going to pay you for your money? And over longer periods of time, they'll pay you a higher return. 10 years is what, 2%? But at the end of the day, and then he's talking about the premium you would get for risk. The problem we've had recently is that risk-free rate has dropped so much that when you put a premium, the premium even is a low number, so it's able to drive up values because as interest rates go down, your value is going to go up. And that's what he's talking about here. Maybe that's what he meant by risk. But for me, you can't avoid uncertainty, but you can be more cautious about it. That's all I'm saying. Now, at what point are you just beating a deal to death? Yeah, I get it. But I'm not sitting there saying, oh, okay, so Apple's grown 10% a year for the last 5 years. I'm going to assume it loses 20% of revenue for the next. No, I don't do that. I sit there and say, okay, let's say they grow at 5% a year for the next 5 years. Let's see what happens there. What happens number? Oh, wow. It's still a good investment. Let's go look at it. I want to take conservative assumptions that are based on reality and say, am I still in the ballpark?
So all this is great. I do agree with this. I do this with small stocks, with big stocks. I do this all the time. I always have a margin of safety, and I'm always like rounding things down. So if a company has 175 million in cash, sometimes I'm like, okay, just 170 or 150. If they owe 189 million dollars, then I'm like, okay, they owe 200. And on top of that, I have my margin of safety. If the stock is worth $1 for me, I don't want to buy it unless it's at 50 cents. And that's that 50% room for error. The company can slow down. And I think that's probably why I've had a high success rate, because on top of everything in my own method, I just have such margin of safety over margin of safety over margin of safety, just so much protection. There could always be risk. There could always be unexpected things and uncertainties, but it goes back like playing blackjack, like counting cards. You're increasing the odds going in your favor. I see it as like 21, like blackjack, and like you're counting cards. So you're putting down, like you have your cards and then you've counted all the other. I don't know if you guys know about counting cards in blackjack. So you know the probabilities of the next card being a high card or a low card. That's kind of what I do. I increase all the probabilities of a stock going my way and me being right, or at least being in the same ballpark. And if I'm wrong, I will be wrong small.
That's what I'm trying to do.
Unfortunately, that's become true for value investing. I can't buy that stock. Why? Too uncertain. That's absurd, and here's why. If you think about companies moving through the life cycle, young companies, teenage companies, companies that peak of their life, middle-aged companies, aging companies, declining companies, it is true that there's far more uncertainty early in the life cycle than in the middle of the life cycle.
Like Palantir.
If you say that you're going to avoid uncertainty at any cost, here's what's going to happen. You're going to be stuck in the mature phase of the cycle, and all you're going to be doing is valuing mature companies. You're removing from your investing universe.
Pause.
Is this true?
This is true, but it's what I like doing. My goal is to find mature companies that the public misprices because it's not fun or sexy anymore.
That's fair enough.
That's what works for me. He is not wrong. I am trying. Gary even said the same thing. Paul, you're really keeping your universe of stocks very low. I said, yep. It's okay for me. But that's what works for me. Doesn't mean it's going to work for you. But Gary has companies that he won't even disclose to us because they're so small that if we knew about them, we could move the market very quickly just by knowing about them. For me, because I remember another thing.
Okay, yeah, so that goes back to what I was saying. Like when you have a lot of money, like you kind of go into this stage 2 where you're buying okay companies at okay, which is what he said, companies that were having issues or companies that no one's liking or having problems, and he finds a good price on them and then buys on them. That kind of to me is stage 2. I'm just trying to be careful with all the people, 99% of people watching who aren't investing millions of dollars that will waste their time, in my opinion, buying all these higher end stocks. And he said it himself. It's his style. It's how he does it, which is great, especially with what he has. And it might not be necessary for you. Now, this Gary guy, it's funny because that's how it is. And it's why nobody talks about like all this little world of true value investors buying $1.50. They don't really share so much because you ruin the play for them. If the market cap is 10 million and you believe it's going to 30 million and you're someone trying to buy 250,000, you have to get filled. You're going to have a high percent. You're going to own a high percentage. You can turn your 250 into $500,000. But once a lot of people start knowing, I mean, it becomes difficult. You move the market. So yeah, that's a whole different thing there.
I sell covered calls on my deals. I sell puts on my stocks. So if I do that, I have to keep my world to a large enough mature company that I can sell those options on.
He said it himself. He needs enough volume to be able to do this stuff, to be able to move money in, move it out, to be able to get filled selling those covered calls. And maybe, so in his method, maybe he plans to hold the stock for the next 3 years. And maybe it's going to be boring for a while. So he can make a lot of money selling those covered calls on the way up, on top of when the stock goes up. But that's a whole different thing now. Now, again, that's big money. When you have small money, sometimes those covered calls, it's not even worth it because it's such a small amount, but you can make a lot of money focusing on these smaller stocks.
And I'm okay with that because for me,
also, another thing is sometimes these smaller stocks, I can name a lot of them. Look at CTHR. That one was worth $1.50 liquidation wise, and it was going for 69 cents. Gigam is worth like $4.50 and it's going for $2 right now. And it's a growing company, I think. I might be confusing it with another one. WSTL is another one. Playmates was one that went from 4 cents to 11 cents in 3 months. It's worth 12 cents and it was trading for 3 cents. And that was just their cash on hand, and they were still growing and doing things and moving forward. Playmates is the one I'm talking about, by the way, that is growing and doing well. So that's where, anyways, let's go.
For me, I have enough. We're just beating the market with options by a few percentage points a year will yield me way more money than I need in my life.
Yeah.
So why go, I'm too late.
It'll give me way more money than I need in my life. Because you have a lot of money. But people who have a lot less money, who have $100,000 or $50,000, heck, the people who are investing a couple $1,000s, it is a different ball game. I already said enough.
Lazy. I don't want to go investigate a $50 million company that nobody's ever heard of because they have more inventory on hand than the company's worth. That's just not my goal. Doesn't mean it's wrong. It's just not my goal. I want to find mature companies, S&P 500 companies that everybody's overlooking because look how boring that company is. Yeah, good.
That's what we like.
That's what I like. Yeah, a lot.
I agree there. I love boring companies. I buy stocks that people are like, why are you buying coal? Why are you buying a paper company? Paper's dead. Like, I love these kind of stocks. I love stocks that are very hurt and people are running away from them. And like, they're like, dude, that's dead. And they look at the stock chart and they're like, dude, it's been going down for the last 5 years. What makes you think it's going to go up now? Well, it was overvalued for the last 5 years. The stock was worth $1. It's been trading at 10, at 8, at 5, at 3, at 2. Now it's trading for 50 cents. So yeah, now it's undervalued. Now I'm talking about 50 cents and all that, but there's stocks worth 20, 30, 50, 100. The things all over the place. I'm just saying numbers to give you like a better idea. But yeah, there's sometimes value stocks that are $20, $50. I mean, just to give an idea, but they just so happen to be smaller stocks most of the time. That's where more doors are. And the thing is, it's like, as you progress, this is why value investing will never die. To invest in these really small stocks, kind of like what he was talking about, they have more inventory than everything. And their inventory alone, even if they had 100 million in inventory of hats, but they sold them all at a discount and they only got 20 million back and it's trading for 10 million. That's a value investment. But what's it called? Well, I lost my train of thought there. Anyways, let's just keep going because I don't even remember what I was going to talk about. Maybe it'll come back.
Now, the smaller and smaller the company is, the more immature, early stage company, the less people are evaluating it. Of course.
Yeah.
All right, go ahead.
Well, in the end, I think for normal viewers is I've been drawn to whatever you've been doing because a lot of times in my life through my multi careers is if I've just followed someone I really look up to, it brings me up to a certain level that I find enjoyable and
but I'm shorter than you.
Oh, I remember what I was talking about. Value investing is not dead and it will never be dead. And here's why. So when you have a small amount of money, the best place to be is with these small stocks, these 5 million, 10 million, 100 million, 300 million. I find them at 300 million sometimes too, the market cap. But eventually you get to $10 million, $50 million. So what happens? That group of people that were taking advantage of these stocks in stage one evolve and go to the next one. And all these other old stocks, new stocks, whatever it is that were undervalued and all these small caps, since everyone evolved and moved on to stage two, it leaves enough room for new people to come into them. And then the same thing happens in stage two, buying okay companies for okay prices. Eventually you have to buy really great companies that you plan to hold for 10 years, 20 years at bad prices. So again, in stage one, you're buying $1 for 50 cents. In stage two, you're buying $1 for $1, maybe $1 for 50 cents, but you know it's going to be worth $3. In stage three, you're buying $1 for maybe $3, but it's a great company. Maybe like Disney, maybe like Waste Management or American Express, but they just market crash, so you get to come in at a great value. But you can hold them for a long time, and now they have enough money for you to go in and out. And then people who are in stage one go back to stage two. It cycles. There's always going to be room. And even with all these growth and high tech stocks, there's always going to be stocks being overlooked and not being seen by people, being mispriced, or bad things happen. Like Ollie. Ollie was a great stock. It dropped from like $120 to like $28. It became undervalued because the CEO just had a heart attack and died. Those opportunities come around. Anyways, let's keep going.
Oh, wow. That's good, Paul. All right, let's keep going.
Thank you.
Those undervalued young growth companies. And remember, young growth companies can be just, in fact, they're more likely to be misvalued than older, more mature companies.
Yeah.
You cannot make avoiding uncertainty the name of the game.
But that becomes a justification now for younger companies. Oh, well, you don't know what's going to happen in the future. So therefore, I'm like, okay, but you can still, let's put some sort of number to it. Okay, let's say they grow at 80% a year for the next 10 years. Oh, they're still overpriced. That's my point.
Yeah, and I think going back to what I just said, folks, if you're watching along and you consider yourself sort of a normal person as Paul, I went actually through the years of these crazy swings. I owned tons of Tesla, Amazon, and Bitcoin.
And Netflix.
And so I was confiding in you like, oh my God, I lost $12,000 today because Elon Musk tweeted something or a Bitcoin buyout happened. And so if you're at home and you don't like those swings and you want to maybe get a little more conservative, and in the end, Paul, I've put myself in a position to most likely be quite wealthy by the time I get older in life.
Yeah, and that's my point. My point is you will be very, very wealthy older in life without having those scary stocks where every single day you're like, oh my God, I hope Elon doesn't tweet something that's going to screw this
That's
stock.
what I'm saying. But I mean, how many of, if you're watching
Okay, so that's another thing. Like, you don't have to have stocks like that. I mean, the stocks that I'm talking about, or like I think you guys should focus on, they don't have. You're not worried. That's the beauty of it. That's the amazing part. You know it's worth $1, so even if you buy it at 50 cents and it drops to 30 cents, you get to sleep well at night because you know what you have. You know the value. You don't care about the price. You don't care about the stock charts. You don't care about the noise. You don't care about who's tweeting this. And the last thing I want to say, and I'm going to have to end this video because it's very long. And we're pretty much done. Is I don't care what title you have. I don't care if you work for what firm you work. I don't care what degree you have. If you have your MBA, I work for JP Morgan. I work for Wells Fargo. You can be wrong. I don't care if you're a firm. I don't care if your firm is downgrading your stock. Funny enough, some of the stocks that I invested money in were the ones being downgraded the most, and even CEOs and insiders were selling them, and it so happened to be near the bottom. I'm not saying I catch the perfect bottom. There's no such thing as catching the perfect bottom. This is the last thing I'm going to leave you on. You're not the center of attention. You are not, the market doesn't know when you're buying. It doesn't care about you. It doesn't know you exist. It's not going to look at you and be like, oh my God, little Timmy just bought the stock at 50 cents. It's time for it to go up. It's falling. The company's distressed. They're having issues. That's why you're buying in the first place. You're a contrarian investor. You're buying when everyone's leaving. You can buy it at 50 cents or at $10 and it can go to $8. You can buy it at $5 and it goes to $2.50. It goes to $3, but you know it's worth more. All you have to do is wait and hold, and you do that because you know the value of the stock. You're not just throwing darts at a board. You're betting on sure things. And anyways, so yeah, that's just the last thing I guess I was just going to throw out there is it's not for the weak stomach. If you're aiming for high returns, you're going to have a high volatility. It's going to be volatile. It requires a lot of patience, and it's just something that people don't necessarily have. And yeah, I have to make a whole nother video and another follow-up. I mean, there's so much I'd love to share and talk to you guys about, but this video is just long because it's a reaction, like it's a video, it's a reaction over a video, and I'm talking about it. So it's just them talking, him talking, me talking, Seth talking. But yeah, let's cut it off here. I'd love to share more, and let me know if you want a part 2, or if you want me to explain the stages more, or if you want me to give examples more, or if you want me to do just cover a part more. I'm gonna play a little bit just to kind of see more, just in case. But
if you've ever had a moment where you lost money in the stock market and then hid this from your spouse, I've probably done that, Paul. You know,
with the economy,
sure,
that people are going to go too boring. I'm not going to own it. Great, I'll own it.
Yeah, we'll get rich slow.
Yeah.
Here we go.
The reality is there are no valuations that are certain. The kinds of uncertainty you might face might vary across the life cycle, and there might be more uncertainty early and less later on. But uncertainty is a feature of investing.
Listen,
I think that's
I
the
love
gist.
this guy. I would recommend everybody go watch his videos. I love him. Mo and I one night just started watching him.
I'm going to skip this part, but I do learn a lot from Oswath, but I don't think you should follow him, but I think you should learn from him. I've learned a lot. He has really great videos and really great talks at colleges and pep talk. I don't know, he has a lot of stuff. So I do recommend you watch him. Just learn from him, learn all the stuff, but don't necessarily apply it, or just take what you believe will help you, but just don't go full force.
So I guess I'm lying when I say I don't watch videos, but it was because Mo has the businesses, but it's still a present value of all future cash flows.
That's a take. Follow, thumbs up. Join our community. We talk like this.
Give me a margin. Great. It's still overpriced. No, Paul, the stock's going to go up. Guys, over long periods of time, stocks are driven by revenue, profit, cash flow. That's it. If you don't agree with that, then we should.
That part is true. That's true. But again, I already explained this. We're looking for stocks to get in and get out. We want a quick puff. We're not there to get a full pack of cigarettes and wait for 2 or 3 years. So, but there's just so much, because there's like stage 1, stage 2, stage 3, and then within each one of those you have different styles, I guess. Some of them involve a little bit of speculation. The best stocks to hold are the ones that are trading for $1.50, but the company's growing, meaning the stock's fair value is growing. Maybe you see a stock and it's worth $10, but it's trading for $5. But every year it's growing, which means that $10 is going to, that fair value is going from 10 to 11 to 12 to 14 to 16. Those are the best stocks, because you get to ride it with it. And then eventually, yes, it does cross. And maybe sometimes it has a huge, people foresee that. And then it ends up trading at $20 or something crazy. Then you can get out. That's when dumb money gets in. There's 3 stages in this. And this is the last thing I'm going to say. You have smart money, which is buying when nobody wants them, when nobody's paying attention. They're the first people. Then you have followers. It's people who follow these people. They follow smart money because they don't have the time to do it, or they just want to do what they do. Everyone has reasons. And then you have dumb money. And by the time dumb money is getting in, smart money is getting out, and even second money. All the money is held in 2 spots, and that's smart money and followers. And you don't want to be dumb money. Dumb money buys when everybody's talking about it. The last thing I will say is, if everybody's talking about it, it's already priced in. Anyways, I'm going to cut it off, but it was amazing talking to you guys and sharing this, and I hope it makes sense. I'm sorry it's really long, but it is what it is.